Hello, traders, and welcome to the Sunday update here on December 17th, 2023. So starting to take in a few trades, close a few trades at some profit this week. Obviously, we had this big slam, I'll call it, when we had a big market uprip. That big market uprip certainly put the hurts on some of the positions that were closed out recently. And we've got a couple that are still open that are being impacted a little bit by that. But I think we have a chance of managing our way out of those or improving those situations, and we'll look at those in a minute. All that said, still looking at nice overall annual profit since starting the service. This is every single trade that has been made since December 1st of last year. And again, on average, we'll have somewhere between $5,000 and as much as about $12,500 deployed. So based on that criteria, we've had a pretty good return, still exceeding 100% for the year. So this is where we're currently at in our equity curve. Now I want to take a look at our open positions here at this point, and let's look at the balance of our open positions. So these are our current open positions now. I'll go ahead and shut down the image here so we've got a full screen that we're looking at. Of course, we've got the Google wheel, which is moving along well. This will probably be rolled later this week. I'll be rolling that short call. It looks like it probably at a nice profit. And then this position is going to require some attention this week. If there is a position that concerns me a little bit, it's this one. Now, while it's got a nice, wide range on it, almost 100-point wide range here in the rut, because this is expiration week on this, the gamma is going to start getting a little bit higher in this. This is one of the challenges that you run into when you have positions that you're battling and you take them closer to expiration. The closer you get to expiration, the good thing is they decay rapidly. So our T0 line could move up into here fairly quickly. The downside is that gamma risk that comes into play. In other words, when this curve starts getting a lot sharper like that, a move in the market either direction can have a significant move on the P&L. So that's something I'm going to have to keep a close eye on this week with that position. This position is going to be much like the one we just closed. And I'm going to take a look at our closed positions here in just a second. But this is much like the one we recently closed and a lot like the trades that we did throughout the year last year that were broken wing butterflies where I did not add any risk to the upside. And the way our markets have performed with this constant rip up, we would have been better off in these sorts of positions throughout the last couple of months, again, given our big market moves, which we'll look at in just a minute. This trade is one that was put on Friday. This is 60 days out. And again, the game plan here is going to be very similar to this one here. So the goal here is as time kicks by, we want to raise that right wing. We may leave the lower wing about where it is because we don't have a huge amount of downside risk right now in our market. Doesn't mean something can't happen, but right now volatility is low. There's no real fear in the market. Same thing over time here. Our goal is going to be to roll this wing up, and we don't want to take on too much more downside risk. So in some cases, we may roll that wing in a little bit as well. But that's going to be the process on managing those two trades. With EWZ here, again, this was a very low-risk, high-reward trade. Upon entry of this trade, I had a total of $7 per contract in risk on this trade, and I had $93 of profit potential. That's virtually unheard of. You very, very seldom find that. So that was a phenomenal reward to risk trade to enter. Now, this does not expire until later this week. So ultimately, this trade could still become profitable. This number that's showing here, that is not a valid number. If that number were a big negative number, it would not be a valid number either, as you need to go back and look at the videos on this from when I entered. The bid-ask spread was very wide in this. So we got a great fill, which is awesome, but because the bid-ask spread is so wide, we can't really trust this P&L number. As traders, we have to understand how our trade works, and we need to know that in this particular trade, if we paid $7 per butterfly to get into it, that is our maximum risk, no matter what our number shows here. So in other words, if our market were to rocket up here to some, much higher number come expiration, we will lose $7 per butterfly on that trade. Our broker will net all of that out and ultimately end up with that result. Now, in this particular case, I have 25 of them on, which is why my P&L is showing, where I've got a max risk here of around $200, something like that. So ideally, EWZ will continue to pull back a little bit maybe next week and get back into this tent. I do have an order setting out there waiting to close. I believe my order is for 5 of my 25. I want to close them if I can get a 20-cent profit per contract. So again, I took in 93 cents. If I can buy 5 of those back for 73 cents, and I've just got a GTC order out there on that, that would be great. That would be a decent return. That would also send me a signal. When that trade closes, I want to come in and take a close look at this trade and see, can I or should I consider closing out the rest of those at that time? So that will be something that I'll be looking to have happen here this week. Again, expiration this Friday, so this also is going to start to decay pretty rapidly with our T0 line coming up into there. So the final one here is SPY, and I am moderately concerned for this one and the upside risk on it, but I'm going to get into some market analysis here in a minute, which should show you why I'm not overly concerned. That doesn't mean my opinion won't change, but for right now, I am not overly concerned on that. But let's take a look, before we get into the actual market itself, let's take a look at the 3 trades that closed this week. So DocuSign was a trade that I had put on it was an earnings calendar in this case. And I did have a chance to close this the morning after the earnings announcement for about a 20% profit. I had an order setting out there to close it if it hit 30%. It did not hit 30%. My order did not fill. And then DocuSign quickly went against me. And on this particular trade, you'll see that the spread here is only 1 week difference. So I did this in a size that I knew if this thing went against me, I was not probably going to have much time to adjust that trade. But, sometimes you'll get a chance to have a little bit of adjustment, but that didn't happen here. So DocuSign opened in a profitable state. Within the hour, it had moved to a slight loser. I wasn't paying attention at that point, or I wasn't concerned about it, maybe is the better way of putting it. I saw what was happening, but I also felt like DocuSign might back up into the tent. So I let it go. The next morning, it gapped up significantly higher. And again, as that continued to gap and run, it just became virtually impossible to sell anything against the long option that was still remaining there. So bottom line was I couldn't really adjust it, and I knew that going in. I knew that with only a week's worth of time, if this went hard against me, I would not be able to adjust it. That's why I put it on in a small enough size that if it was a complete loser, I could deal with that. So, and that is what happened on this particular trade. The next one, let me just So this is CrowdStrike, also an earnings calendar. What I want you to notice, it's a little bit different here, is that this one, first of all, it was a little bit larger size. It had a little more risk associated with it. But I also did it in a way that there were 2 weeks of time difference between the front short strike and the long strike. That gave me an opportunity to roll short strikes multiple times before this trade ultimately were to end, ending at the long strike expiration here. So that was kind of what happened on this one, is that I left myself enough time that I could roll this thing. I mean, I rolled it once, I rolled it twice, and I could have rolled it a third time if I wanted to, but I was able to hit my profit target with a GTC order after I had done that second roll. So this one closed out at about a 28% profit in a matter of, I think this one, 16 days was this one. So again, main difference between this one and DocuSign is on this one, I allowed myself extra time between the short strike and the long strike. Those of you that have taken the deep dive calendar and diagonal class will know exactly what happened there and have an understanding of that. If you are interested in these types of trades and have not looked at that, I do urge you to go to my website at sjgtrades.com. Take a look specifically at the calendars and diagonals class. I do spend, probably close to a couple hours in there at least on earnings calendars or earnings diagonals, time spreads, if you will, around earnings. So let's take a look at that last trade here. And I think that should be this one, which is the SPX Condor. So that SPX started off as a Condor, was in this thing for, a fair amount of time in this particular case, 43 days. But the benefit to this type of trade is that it was traded as a broken wing butterfly. Actually, it started as an all-put Condor that was broken wing to the upside. And I never added any upside risk to this trade. So it's not unlike the two that I just pointed out that we recently entered that are broken wing butterflies that have a little risk or no risk to the upside. Since our market right now is, powering higher, I want trades on that aren't going to take on heat if we continue higher. And or if we chop back and forth, they can start making money through time decay. So that's what we're going to be looking at here specifically is how some of those trades might play out in our current market conditions. So if we take a look at the SPX, we can see here specifically that we did come up to a new high. We chopped sideways for about a week there, and then we blew out. And I say a new high. This isn't technically a brand new high because we have traded as high as 4,800 a little over a year ago. But as far as recent times go, that was a new high, and I was expecting to have a likely pullback at that point just because of the resistance that was there. But again, we can see that while there have been resistance points and the market respects it for a day or two, ultimately it has popped through, again, multiple different resistance points here, that market has kind of respected for a short period of time, and then it just rips right on through it. So that could continue to happen. The last 2 weeks of December is often what is called the Santa Claus rally, where the markets do power higher. Now, we've already had a very big move here in December, a move that normally exceeds what the markets tend to do in December. So that may be a case for a little bit of stalling, if you will, at this point. But when I'm putting on new trades right now, I have to put them on with a bullish configuration in mind. So that's pretty much what I've done. And again, that's for two reasons. One, of course, is this breakout to new highs. And look at our volatility here. So the purple line is historical volatility. The blue line is implied volatility. Both of them are very, very low. The fact that historical volatility is low this time of year, well, that's because of the Santa Claus rally, and we usually have this rally and limited fear going into these last couple of weeks of the year. And so that's why the historical, the purple line, is that way. The blue line is that way because it's a measure of exactly what's happening in the market right now, the number of people that are buying insurance or buying puts because they have a level of fear. There just simply aren't many people buying puts right now. There just isn't a level of fear in our marketplace. So my expectation right now is that we might get a little bit of a chop sideways. Maybe we even get a little bit of a pullback, probably not much of one. And then I would expect that by the end of the year, we're probably going to be looking at some new highs. So that's kind of my temporary expectation here in SPX. If we look at RUT, we're going to see similar. But the RUT is in a fairly significant resistance area right now. Now, what I would have liked to have seen Friday on RUT is I would have liked to have seen it pull back maybe around to this area right here and close that gap. If it pulled back there, chopped sideways a little bit, then it would likely move back up here, maybe go sideways a little more for a day or two, and then ultimately probably blow back through to the upside. But again, this is a massive, massive couple week move in the RUT. You don't normally get upside moves like that. And of course, a lot of that is because of the whole the Fed coming out and dropping interest rates, not dropping interest rates, that's an inaccurate statement at this point, setting the expectation that interest rates are likely to drop at some point here in the future, or at least that we're done raising for the time being. So bottom line is the Fed is very dovish. They're essentially saying, we feel good about the economy and where the economy's at right now. We're not ruling out additional future adjustments higher, but they largely feel like they've gotten the job done that they needed to get done at this point. So that's kind of a rough overview of the market as well at this point. So that's it for, let's see here, December 17th, 2023. As always, please like if you would, and if you have any questions, drop them in the comments. I'll do my best to get them answered for you. Take care.